Thanks for joining, gents. I don't know if any of you were sort of sitting in on that morning discussion, but it covered some great ground around sort of where we're at and some of the perfect storm of macro challenges that we're facing in the world. But then we also tried to get a sense of whether this creates good opportunities for investors or very difficult opportunities. And it was great hearing their navigation of it. But Mr. Geiger, I always like your commentary when you come and speak for us in terms of sort of where we're at with the macro. You have quite a good view there. Do you want to start us off maybe before then we can delve into some of the investment strategies as well? But I'd love to get your take on where you think we are with this kind of perfect storm at the moment with some of the recent banking issues, the Fed hikes, etc., and where the commodities sit within that.
Is this mic working?
Sorry, is there a button on that? Are we on?
Testing. There we go. That sounds good.
Cool.
Yeah, so I remember sitting on a similar stage here in Vegas a year ago, and I think there were 4 panelists in total, and you asked us whether the next gold run had begun.
Yep.
And 3 said yes. I said not yet. I said we have a great decade ahead of us, but not quite. Regrettably, that was correct. More correct than I expected. That was actually, so this would have been March or April of last year. So then we proceeded to lose money, or the gold price proceeded to decline 7 consecutive months, which was actually a record for the metal. So an extremely painful period, really, from the spring of last year through October, November of 2022. My opinion has flipped. I think we are decisively in the next move. Combination between the price action that we've seen over the past 5-6 months since the bottom in early October, and additionally the macro backdrop, specifically for precious metals, as you brought up. I think there are a couple key forces going on in the background that are only going to gain momentum, and folks actually aren't talking about it nearly as much as you'd expect. The first is the fact that last year global central banks bought more gold than in any year going back to 1950, if not beyond. So since records have been kept for central bank gold buying, there's not been another year where there's been more gold bought than last year. That's a pretty stunning fact. And I know plenty of folks that own gold in their portfolio that aren't aware of that fact. The reasoning for that, briefly, and I think it's important to understand, it really comes down to the Biden administration's decision in early last year to freeze Russia out of the SWIFT banking system. That was a shock to the system, of course, for Russia, but also globally. And it just makes common sense for other central banks that hold a large percentage or a decent percentage of their currency reserves in US dollars to rethink that, especially if it's a country that may be on the fringes with the United States, may not always agree on certain decisions. So we don't need central banks globally to ditch their US dollar reserves en masse. We just need them to lower it to some degree. And I think the buying of gold we saw last year is a direct result of that decision. And I see no reason why it's not going to continue. I mean, this could be a multi-year trend that we're having.
So the squeeze on bullion is driving some of this price, as well as
yes, well, central banks stepping in as
financial market insecurity,
major buyer. Yeah, and that's the second angle. That's a more of a recent phenomenon, really, starting with the failure of Silicon Valley. Well, I guess this failure of Signature Bank, then Silicon Valley Bank. Most recently Credit Suisse. And another little factoid: the rate of change for bank deposits. I'll rephrase that. There hasn't been a sharper decline in bank deposits from a percentage perspective going all the way back to 1970. So that's another 40 or 50 year phenomenon that we're seeing. And so we have central banks scrambling towards gold, and I think we also have individuals reevaluating where they're keeping their dry powder and maybe whether they should make changes.
Yep, absolutely, excellent. Matty, I don't know if you want to comment to that sort of level on the macro stuff, and also if you could introduce what you do as well as first time speaking for us.
Yeah, sure. I mean, so I've been involved in the space for about 15 years, and we are more on the company side, but we're fairly large investors in ourselves. And actually, Mike's group at RCF was one of our biggest backers with IPO, the largest lithium mine in the world, Talison Lithium. And we're primarily gold and silver for the previous 10 years. And then Matt also knows the ones I currently work with in sort of the battery metals space. But we do talk, Matt and I talk a lot about macro issues. And, in the spirit of improv, I certainly agree with them and would like to add, in our specific space, we've never seen, in our careers, the lack of liquidity that we've seen over the past year. But guys that have been around for 10 or 15 years know that it's kind of always darkest before the dawn. And, you'd kind of have to reassure guys, especially on the corporate side, that, things are not going to change until you see the US dollar turn over, to Matt's point, a little bit. Like, it doesn't have to go down too much, but it really does have to kind of stabilize or sort of start to trend down to start to see those the confidence of things pick up. And Matt knows that I'm appropriately named Matthew as well, that I'm just a disciple of his work, but I spent a lot of time with reading Martin Armstrong over the last 15 years. And, his point is always that, gold and silver will have their major moves when people lose confidence in government. And I think we can probably agree that we're starting to see that.
Yep.
And with that, I also really like the silver space to go along with the gold story. So that'd be my comments.
Excellent. Yeah. Mike, thanks for joining us, stepping in. Tell us.
What are we talking about?
The macro's done, dusted. We've had a good stint on that, and Matt's captured it very well with Matty's support and that morning panel. But look, tell us about 48 Capital as well, and like what you're doing. And there's a liquidity squeeze in this space. Maybe we can move on to talking about junior mining and where this capital allocation is going, and this opportunity perhaps here that certainly the generalists maybe aren't seeing yet, but you as a specialist is looking to exploit.
Sure. Yeah, thanks. So I left RCF a year and a half ago or so. I spent 8 years there in a principal investing role. I'm a mining engineer by background, proudly a non-geo, but which gets me slapped around at conferences like this a bit. At RCF, we did everything from early stage exploration investing all the way through to construction finance, late stage investing. Have recently launched a new endeavor that we're calling 48 Capital, and our tagline is we're growth capital for the mining industry. So the concept is that we want to fill a void that we believe exists between the high net worth folks or retail and the institutional groups like RCF, Orion, Appian, EMR. All of the groups provide, critical capital to the mining space, but we believe that there's sort of this middle part that just frankly isn't as exciting for the market, where companies still need capital. They want to raise, call it, $5 to $15 million. It's not a check size that's big enough for the later stage PE, where you have sort of a combined, 15 billion of AUM across a handful of groups. But it's maybe too big of check sizes to go wrangle it up from all the high net worth folks and, out of Vancouver, West Perth, that sort of crowd. So we want to be able to fill that as a sophisticated partner in an institutional sense. So it's still sticky money. We really want to move the ball down the field and in a true partnership with the issuer. So from our perspective, it's maybe taking somewhat less technical risk. We're all technical people by background, but we're not subject matter experts, or we don't believe we are anymore. So we're saying call it roughly post-discovery, where you can at least see there's enough smoke to believe that there could be fire. But at the same time, we're not taking the complexity of investing at project finance or at that stage. That's a totally different skill set that you need in the institution. That's where RCF and Orion and Appian can play that game.
Yep.
We're trying to help the company get to the point that it needs that capital.
Yep.
So gold and silver, I'm glad you commented on it. We're looking at, buying into this energy transition concept, fair enough. I think the unique thing, and the guys this morning mentioned it, is that, we as a mining industry no longer need to convince the general public that mining is a thing and that you need copper and nickel and lithium and whatnot. When you see Goldman Sachs puts out an article that copper is the new oil, Financial Times, Fortune, Bloomberg, Vice, there's a ton of media outlets that are now talking about this thing called mining that nobody's ever heard of. That's a great thing for the industry. So now it's just a matter of convincing investors why they should back us versus one of our potential competitors, or one of the longer lasting groups out there that have the long track records associated with them. And fair enough, that's a different conversation. So I think from our perspective, we're looking at, investing across a suite of, we don't want to touch the entire periodic table, but at the same time, we're going to concentrate on certain metals that are obvious. Copper was a big theme this morning. I think it will continue to be. The world needs, say, on order of 6.5 million tons of copper by 2030. That's a huge number. Rio, the fifth largest copper miner, mines 500,000 tons a year. So to put that in perspective, you need 6 new Escondidas to fill that gap, right? Which is wild. So fair enough. That's an easy one to talk about, right? The more complex ones, I think, are something like gold and silver that, over the years had been relatively simple, but then people, in light of ESG and today, are saying, well, what do you actually need gold for? You don't need it for any industrial application, arguably. You need silver for sure. But, gold is sort of too expensive for industrial applications. And it's, so then what, right? Well, then it comes back to the macro aspect. Do you value it as a monetary instrument rather than some industrial usage in the energy transition? So it's, I think we'll ultimately have exposure to gold, but, just from a portfolio diversification standpoint, if anything else.
Yep. Okay. Interesting. And just thinking back to what you do you're an earlier stage, as you mentioned, sort of ahead of some of the sort of more developmental PE specialist mine finance, but are you looking to sort of exit at that point, or take companies to a certain level, help them in that sort of partnership approach, and just getting an idea of that sort of time frame within which you have in mind?
So relatively patient capital, right? The issuers need patient capital. This industry is plagued with liquidity issues across the board. So we want to be that patient partner, call it a 3 to 5 year sort of horizon. If we have a positive return earlier than that, nobody's going to complain. But we're at least offering to the issuer this capacity to be there for the long term. If we're exiting into one of the bigger groups that's then coming in to build the project, maybe. I think from an exit scenario standpoint, there's a variety of ways that can go. I think all too often, if you're stuck in 50+% of the equity, your exit is an entire takeout of the asset, right? Yep. You can, but it's a challenge to float 50% of some mid-tier company on the market over some reasonable amount of time without cratering the thing in the process. So for us, we're also going about it from a very different ownership perspective or philosophy. We don't want to be in a control position. We actually think that brings on a lot of challenges. We want to be sort of sub 20% at most. So it's also, we want to put ourselves in a more nimble position as well.
Yep. Okay, great. I want to talk about the junior tier then. Perhaps valuation came up quite a lot this morning around, the sector being incredibly undervalued. But how do you see, Matt, maybe we could start back again with yourself in terms of how you see value within this sector, and how do you look to exploit that, I guess, as an investor with your own strategy?
Right. Well, I'd first look at it from the mining sector at large relative to the general economy. And I think we can say definitively that we are, if not historically cheap, very cheap based on historical terms. So you can look at a whole host of metrics. You can look at the weighting of metals and mining companies within the S&P 500. That weighting is about 0.5%. Just back in 2011 and 2008, it was closer to 1.5 or 1.75%. So you could see a 3x increase in the weighting of metals and mining companies within the index before we reach kind of the highs of the last cycle. Same goes if you include oil and gas companies in that. I think the weighting with oil and gas included for natural resources generally within the S&P is 6 or 7% at the moment, and in 2008 that rose all the way up to 30%. So these are kind of back of the envelope metrics you can use to have a sense of where we are in the cycle. You can look at commodity prices generally, physical commodity prices relative to the broader stock market. We haven't seen these levels in decades. So from a longer term perspective, that gives me quite a bit of conviction that we're in the right place here.
Yep.
That has no bearing on what occurs in the next 12 or even 24 months. But over the next 3, 5, 7 years, I feel quite comfortable that those that can pick good teams to back and can hang in there through the volatility are going to do exceptionally well.
Yep.
Now moving to the juniors, I guess zeroing in on the mining space and then comparing the larger names to the juniors. The juniors are lagging. There's no question about it. I think it's important to differentiate between precious metals and the battery metals. I guess just focusing on the precious metal front, we've seen quite a bit of inflows to the larger blue chip gold and silver focused names over the past 3 or 4 months as the gold price has moved. But we're at the point in the rally, and that's assuming that this is a sustainable move, where only the biggest and most liquid names have benefited. And I remember going back to, and that can be extremely frustrating for a junior investor. It can be a real test of faith. I remember going back to 2020 after the COVID bomb out in March or April of 2020, after the markets had crashed. And precious metals started to move, and the major miners and the major producers started to move. I remember looking at the MJG portfolio. We're very much weighted on the junior side of the spectrum. We have about a 50 million Canadian median market cap or so. So it's definitely some of the smaller names. And we were gaining, but we were up a few percent maybe in March and a few percent in April and 5% in May. And these large producers were up 40, 50, 60%. And it was a bit of a trying period. We stuck with our strategy, and sure enough, that move was real. And come June, July, and August, we played catch up and then some, and ended up the year 115% in the fund. Yep. After really, it took about 90 days for the juniors to really start to move, and that was a trying period. So if this move is real, it feels like we're still in that earlier stage where the money has yet to even dribble down to the mid-tier names, let alone the penny dreadfuls of the junior space. So. Yeah, and again, that depends on this gold price being sustained. Based on what I'm seeing, that is the case, and I'm going to continue to feel that way unless we see gold, drop below 1,700 or back down to 1,600. Then I'll reevaluate. If and until then, I feel confident that this is the start or the earlier stages of a substantial leg higher.
Yep, excellent. But in terms of the pattern in history. It's the gold price, then the majors, then the juniors, So, okay, excellent. Matty, you helping companies raise capital and sort of knocking on the door of all manner of investors as well. Talk about some of those challenges in the sort of that liquidity squeeze that this sector knows all too well, and sort of how it feels now within the junior tier.
And just getting back to liquidity itself, both Matt and Mike have a much broader scope than I do in terms of what they look at and the amount of names that they see. But if I look at it just from a pure trading standpoint, like I said, I've never seen it as liquid as is today, which is a double-edged sword. Like the move that we've seen in the lithium prices is partially because of the vagueness in how that's valued. So if you take it from a pure deep value investor standpoint, having that lack of liquidity, knowing that you'll see the moves in the major companies first in each one of those commodities, and specifically talking I guess about gold and silver now, that's going to give you the indication of when you're going to have those moves. And from an investor standpoint, it's times like this where I make my best friends, right? When nobody cares, because you do have to have conviction. Oftentimes it takes a lot longer than you'd hope. But those where you have the biggest paydays, I guess, for lack of a better term.
Yep. What about this notion that was raised this morning around lithium, being so hot? You want to align your marketing and your brand, or maybe pick up a lithium asset to go with your gold development project. Do you see lithium sustaining as well? Does anyone have a view on that?
if you look at Taliesin, for example,
Yeah.
that was a $848 million takeout, which was great. It's my biggest win in the market at that time. But if you looked at it today with today's lithium prices, that would be $5.7 to $6 billion. So it's gone very far, very fast. So I kind of focus more on, once again, the things that people are not talking about, like graphite and silver and nickel and things like that. That would be my take on lithium.
Yep.
Yeah. I mean, for a patient, relatively sticky institution, I think it's hard to chase lithium right now. Especially if you don't have liquidity or relatively limited liquidity, then, if there is a correction in lithium in the next 6 or 12 months, then what do you do, right? You're just holding the bag because you're the one that's stuck in holding 20% of the thing. You look at the underlying asset value of a lot of lithium names or new stories that are out there, and you're in the hundreds of millions of market cap for these companies that have maybe a drill hole. That's really not heard of, at least anytime recently. And in lithium, fair enough, like it's going to be important for some amount of time. But the technologists, if you believe anything that they're talking about, they're trying to figure out how to get rid of lithium in batteries whatsoever because they just don't want to deal with it. And so you have PhDs that are far smarter than me trying to figure out how to make silica-based batteries. Well, so then you have an infinite supply, and so how does it play out, and how fast does that come? The mining industry evolves much slower than just about any other industry out there. We're less innovative than agriculture, which is saying something. I think lithium's, it's needed. It's hot right now. What does that look like in 5 years from now? I'm not sure. Go ask the battery engineers at Tesla, what they're going to be doing. Yeah. So from an investment standpoint, it's hard to find interesting lithium picks if you're trying to find good value. There's a lot of interesting stories that, you'd love to be an investor in your PA perhaps. Right. But to get in early and, try to demonstrate some value add for your investors, that's difficult right now, unless you're getting into, a new private story that's just not on the market yet. Maybe where you can throw your weight around a bit more in negotiating terms privately. So lithium's tough. It's tough to find good value right now.
Yeah, not to beat a dead horse, but I'm very cautious on lithium at the moment. A believer in lithium longer term. I think the thematic's real. I think the EV revolution is real, and some of the more optimistic projections could come to pass or close to come to pass. That doesn't stop highly promoted lithium juniors from falling 60 or 70% in the meantime, right? And I guess looking at some of the market behavior, it's reminiscent of previous flavor of the month metal booms that we've seen in the past. We now have over 200 lithium juniors between North America and Australia. You have companies that have been focused on gold for the past decade, suddenly finding a pegmatite occurrence, in the southwest corner of their property, and their share prices, booming 40 to 50% overnight based off of a press release. In January, I can think of 3 prospect generators that actually are good companies with good overall portfolios announcing simply that they have lithium within the portfolio, and the share price is moving 50 to 100%. This is the type of market behavior that's indicative of a top in terms of a hot metal. Yep. And we've made good money in lithium within the MJG fund. Between 2014 and 2017, we were shareholders of Lithium Americas, which, while we owned it, moved from $1.20 split adjusted up to $13. And I think we sold at $12.75. Played it pretty well. Maybe it reached $14. Then proceeded to fall down to $3.50 over the next 2 years. I was feeling really smart about myself. Oh, great timing. We got out just in time. Now it's a $60 stock. Yeah. So there's plenty of booms and busts in this industry, but I know for sure if I hadn't have sold at $12.75, it would have been very difficult to hold the full position down as it fell through $3.50. A lot of people, when things are going well, say, oh yeah, I can bite the bullet and hold this for 5 or 6 years, no problem. But when 2 years down the line, they're looking at a 65% loss on paper, it's in practice, it's very difficult to actually hold through those scenarios. So yep. I fear that we're in a similar situation for lithium here. I mean, it's done some good to the space. There's a lot of new investors that have come into mining.
Think of MG putting into lithium companies and sort of bringing that supply chain closer, and then raising awareness, and maybe a generalist or people that are understanding now the battery
Right.
the very basics level of a battery that you need lithium for
Yeah.
lithium ion for your EVs. It's got to have been positive in terms of a narrative for the space.
For sure. And I hope some of the retail investors and the generalists that have come in due to this lithium boom over the last 18 to 24 months have diversified into other metals, at least into other battery metals, if not precious metals.
Nickel perhaps might be getting some shine in that respect.
Say that again.
Nickel perhaps.
Sure. I mean, I haven't seen nearly the speculative attention really on anything but lithium at the moment. Maybe rare earths. Uranium always has a little bit of a hoopla around it that metal attracts a special type of investor. Some overlap with silver investors as well. But yeah, graphite, very little attention being paid to graphite. Nickel, I would argue, Elon Musk is on the record saying lithium ion batteries should be called nickel ion batteries. It's a misnomer.
Yeah.
There aren't that many high quality nickel focused juniors out there, shockingly. I mean, there's got to be 10 or 20%, if that, of the amount of lithium names that are out there, promoting their wares. So it's this decarbonization push globally, which I do think is real. I think it's supported by governments and many consumers. There's more than just lithium that's needed to make this tick. We've talked about it, whether it's copper. I mean, copper is our largest weighting by metal within the MJG portfolio. So I think that's one of the easier ways to play the decarbonization trend. You're not necessarily getting that torque that you would with lithium or graphite. But we need new copper discoveries, and we need some of these later stage development projects to actually make it into production in a reasonable time frame here.
What do you think about China coming back online? There was talk about that this morning. A copper squeeze, and that some people were saying the incentive pricing is not quite there yet to really kick this sector on. Do you think that coppers could shoot up and have that incentive pricing?
Yeah, it's a tough one. I mean,
teed up well.
We've never been in this situation before where we've had the world's predominant consumer of copper. I think China's at 40, if not 50% of global copper demand, just an absolute gorilla in the room, turning on their economy from scratch at the same time where the global economy seems to be slowing.
Yep.
So it's a very interesting tug of war going on. I'm mixed. I don't have a very strong position. Fortunately, the investment horizon of the MJG fund is longer than just 1 year. So if anything, I'm bracing for the worst. But I'm expecting copper to be much higher and for our equities to be much higher in the matter of 3, 4, 5 years. This next 12 months is going to be fascinating. I mean, you have smart groups, Trafigura's out there, Glencore CEO, saying that we could see all-time high copper prices within the next 12 months. I wouldn't count that out at all.
Yeah.
But that's a pretty fascinating dynamic. I don't know if you guys have any sense of how that's going to play out.
Yeah, I mean, I certainly agree with those sentiments, and really that you brought up the next 12 months. The next 12 to 14 months is going to be very interesting for our space. And once again, parroting Martin Armstrong's work, we do have a massive commodity boom coming, not necessarily because of economic demand, but because of shortages. And Mike brought up the point, the major producers just not being there to supply that, and it's going to have to come from somewhere. So I definitely agree with that.
And they're under investment for a while.
Yeah, well, I mean, part of the problem is that so lithium, it's an immature market. So then that means it's going to drive more volatility. Fine, without I'm the furthest thing from an economist, but I mean, you can see the hoopla. The U.S. produces all of 3,000 tons of lithium right now. Thacker Pass hopefully comes online soon, and that changes that number a bit. But 3,000 tons out of one of the world's largest economies into a total market of, call it circa 700,000 tons. And estimates to 2030 is that the world needs, 1.5 million tons or so of LCE. That, on a very immature market, that's a really interesting growth profile. And there's a lot of reasons to get excited about some of these new assets that are arguably easier to bring online than a complex copper, especially a complex copper porphyry. But remember, every new electric car, say, your average Tesla has 9 kilograms of lithium in it, 55 kilograms of copper. Mm-hmm. So as much as people are excited about lithium because there's going to be a bunch of new electric cars driving around, well, you should be 5 times excited about copper, right? Regardless of what happens with infrastructure and sort of infrastructure scale energy transition.
But where are the plays though? There's not as many good copper assets or juniors, or maybe some copper gold, a lot of copper gold juniors, but like, so it's kind of matching that the investment opportunity as well as the supply demand disconnect.
Yeah, and it's also challenging. I mean, you see a lot of interesting projects, especially in South America, that are managed by juniors that have 10 to 30 million market cap, and they're sitting there trying to develop a project that, upon getting built, would need billions worth of capex. And so how do you do that? Well, good luck. I mean, it's really complicated. Hopefully you can, march your share price up over time by putting out good results and getting the market excited. That would allow you access to that liquidity without destroying your own capital structure in the meantime. But it's a challenge, right? So that's difficult. If you go for the smaller capex, higher grade, sort of easier to bring online or manage operations that you're seeing emerge, these days, or in the last sort of year or so, out of Canada, especially Canada and the US. Well, those are easier ticket sizes to swallow and easier to manage for the company, the community, the environment. I mean, they're just simpler projects. However, if we need to fill a 6+ million ton gap over the next 8 years, bringing on 40,000 ton a year projects, you need 150 of them or whatever. And so where are those going to come from? You can probably grab the right handful of people in this room and count 20 maybe, but 150, who knows? So it's a challenge. And so I think that's where, I'm massively bullish on copper because of all these issues. Lithium's fun, it's exciting, and it's new. But for how mature the copper market is, I don't know that people have really finally reconciled what a dire need we're going to be in here soon, regardless of what happens from a Chinese infrastructure standpoint. Yeah. So
it's interesting. Aside from the money that's not quite flowing enough to get these projects developed and up to the next stage, what do you guys, as investors, advisors, think is the biggest challenge, particularly for a junior at the moment? Is it the ESG pendulum that swung too far? Is it the permitting? Is it the lack of support beyond our sector, perhaps?
I mean, I think you just answered it. You answered your own question. It's a whole fleet of things. You look at the U.S. I mean, the U.S. is in a interesting position. Maybe somewhat like Canada, in the sense that you have a federal government that says they're supportive of mining, supportive of critical metals, right, or critical minerals, but they're not really supportive of the upstream side of things, like we talked about somewhat this morning. So the dollars that are being provided by the federal government actually really aren't helping to get the metal out of the ground. Yep. It's helping all the downstream stuff. Great. You also have a group of people that follow the NIMBY concept, and so you want your electric car, you want the cleaner burning vehicle, but you don't want the copper mine and the lithium mine in your background or your backyard. So then what? But you also really don't want the issues that are emerging in East Africa and some of these other child labor problems that we're having in the industry, which are horrific. Mm-hmm. And so the industry should be condemning that entirely. But to be able to condemn that, we also need to then harness what we have in our actual backyard and help bring those things online. But then you get into ESG issues, permitting issues, and so the industry hasn't always done it well. Right, we've done a lot of bad for our own selves, but there's an education issue at play, and the industry needs to be proactive, I think, in educating the general public about what it is to be mining, and that we can actually do it cleaner than we did 50 years ago and cleaner than 100 years ago. But that conversation doesn't really seem to be happening. So then you're sort of stuck. There are minerals we could bring online today, or a couple of years from today, throughout the U.S. and Canada, right here on our home soil. But there's roadblock after roadblock after roadblock.
Do you see the permitting scenario in the U.S. changing at all? Just with the positive agenda and the sentiment, and then of course the demand. Something's got to give.
I do, actually. I mean, the jury's still very much out. I guess the first case study or positive case study would be Ontario. Again, but both in the United States, Canada, EU coming out with fiscal support. Australia has been ahead of the curve. There's a lot of financial support to push these projects forward, but permitting has been neglected. And that's the most important part of the equation. So you have the Ontario Minister of Mines, stating that the average permitting timeframe in that province is 12, 13 years. They're trying to shave 3 or 4 years off of the process. So that's kind of the first positive rumblings that I've heard from regulators. Look, there's always going to be controversial projects that just simply aren't going to be built. And I think that's going to remain to be the case. That said, I think that regulators will start to get the message. It's going to be slower than us in the industry but permitting is the real bottleneck to actually push these. Capital is part of the equation. We're starting to see that solved in some degree, but actually shortening these permitting timeframes are important. I'll also note I'm starting to see a little bit of a dichotomy between, as Mike mentioned, gold projects specifically and critical mineral projects. There was an interesting Bloomberg article, I guess it was 6 weeks ago or so, based off regarding the Trilogy's project up in Alaska, and there's a somewhat controversial. It's actually not even particularly controversial. Ambler Road that needs to be constructed for these deposits to come online, and it's been at least put on pause by the Biden administration. And there's an interesting quote by an NGO. Who's largely an anti-mining NGO, but even that NGO was drawing the distinction between, is this a gold-focused project or is this a copper-focused project? And I think that's probably a phenomenon that's going to continue. Gold, of course, if it was a tenth of the price, would have many industrial applications, but at its it's an extremely conductive metal. It's extremely useful metal. But at its current price, it's only going to be used where it absolutely has to. 90% of gold is going towards either jewelry or, investment in coins or bars as it stands. So all things equal, I think it's going to be a harder boulder to push uphill if you're permitting a gold project versus copper. That said, a copper deposit located near a sensitive environment, a sensitive community is simply not going to get pushed through. And there's plenty of gold projects that in the scheme of things have minimal impacts that can be pushed forward. So I wouldn't want to paint with too broad of a brush. But I do think that specific metals, projects focused on those metals are going to get a little bit of an extra push.
Yeah, excellent. Okay. Circling this back to investment strategies then, we've covered a lot of themes. How do you build optionality or diversification within your approach to investing into companies? You've got we know that lithium might be at a bit of a bubble for you guys, and delineating good assets there or companies there isn't right for right now. But within the commodities that you like, how do you ensure that you're not overly exposed to that? Or
Sure, I can hop in. Just speaking to MJG, I think this comes down to investor preferences as well. We largely have 4 buckets that we'll invest in. First is pre-discovery. And if we're in a pre-discovery name, it's almost certainly going to be a prospect generator. That's a business model that's extremely out of favor, partially for good reason, but a lot of these businesses are priced like that. So you're able to find PGs that are trading, close to their cash breakup value. You're able to find PGs that are, have half of their, market cap covered by cash and marketable securities. So I'm quite intrigued by those opportunities where you have the upside associated with early stage mineral exploration, with at least some defined downside provided by a healthy cash position. So that's one bucket. Then there's kind of the post-discovery names that Mike alluded to earlier. This is where, a new discovery appears to have been made based off 1 or 2 drill holes. There's no guarantee that it's going to become a mine, but you're thinking, okay, it looks like there could be something here. Whether it's big enough, whether it's high enough grade, that remains to be seen, but I think it's headed in that direction. So that's kind of the second bucket. Third would be what I consider late stage development plays. So projects that are hopefully working their way up the Lassonde curve and either have a chance to be credibly built at current metal prices or taken over by a larger group to take that forward. And then the final bucket is royalty names. About 30% of our portfolio is weighted towards the royalty business model.
Yep.
I think that's, for a longer term investor, an excellent way for exposure to the metals and mining space. You maybe won't have quite the torque that you would with producers or larger developers when metal prices truly do turn, but it's so hard to actually predict the cycles and the timing of when metals move over cycles. The royalty business model has proven to be an excellent way for exposure. Just to your point about optionality, I'll just add, when I hear optionality, that's a very specific jurisdiction for me, or sorry, a very specific definition for me.
Yep.
Optionality is where you have a large, low-grade deposit that simply does not make sense at the current metal price. Think of a large copper asset, 0.5% copper or below, located away from infrastructure, but super big. That will never be built in a million years if copper stays at $4. However, if/when copper moves to $6 or $8, doesn't mean it's going to be built, but at least on paper, it's going to be worth a ton of money.
Yep.
And so there are specific investors in this space who have, that's their bread and butter, optionality investing, the Thomas Kaplans of the world, the Sun Valley, Peter Palmettos of the world. That's a perfectly fine way to invest. That's not my style at all. We largely stay away from that play, those types of plays. I guess a broader definition for optionality, the closest thing within the MJG portfolio is the kind of prospect generator or early stage names that I alluded to, where you have the optionality that's associated with early stage mineral exploration. But if things don't go to plan, you're not losing 90 to 95% of your money. I mean, a company here, Almadex Minerals, has 18 million in cash, 17 million in cash, 18 million in cash and marketable securities, $21 million market cap. They're drilling 3 or 4 projects this year. So you get the upside. It's low odds for each of those drill programs, but the downside if they don't hit, seems to be 15 or 20%. That seems to be a pretty good risk reward for a team that's made discoveries in the past. So that's kind of the closest to optionality that we have within the MJG portfolio.
Excellent. Yeah, very thorough. Matty, do you have any comments on diversification within other corporates, but then also how investors looking at it?
Sure. So the first way I look at it is geopolitical risk and where are the projects located. So I've been very focused over the last 4 or 5 years personally in what I am involved in with most of my time in Africa. Previous to that, it was Australia, Chile, Nevada, primarily, some in Mexico. But you do have to be aware of where you're investing and current political and geopolitical dynamics. The other part would be what types of metals you're choosing to get involved with. So if it's something I'm taking on myself, it would be something that's, completely out of favor and I can build as big of a position as I can. And, we like to talk about it as, first guys in the dressing room, last one out, because we largely take a mergers and acquisitions type of approach to what we get involved with. In terms of a investor standpoint, so taking off an advisory hat and just as an investor, this is an obvious one, I'm sure, to everybody, but it's who's running it, right? And what have they done in the past? So the best groups that I go with are, the best people, typically with the best projects with the best grade, and then who are their investors and who are they partnered with, and what today's probably the best example where you can have, most of the move in front of us and find the cheapest names. Like I've never seen as much value as you see today in gold stocks and silver stocks in the 15 years I've been doing it. So I think optionality would be taking on something like that that's extremely cheap, that has good partners, has a good resources and a good jurisdiction. So from a pure investor standpoint, that's something that I really focus on.
Yep. Excellent. Mike, could I just get your view on getting that risk return balance right?
Sure. These guys have said it. You want to look at diversification from a commodity and jurisdiction standpoint, of course. There's a fine balance. A lot of people have made a ton of money by being a first mover into a tough jurisdiction. You have to have deep pockets. You have to have a very long-term mindset. And that's a strategy that's worked out very well for folks. You can maybe do less brain damage by not going into those jurisdictions arms wide open. I think there's plenty of value in good projects being ran by good teams and easier, relatively more stable jurisdictions. Or what I mean by stable is just having a stable mining policy framework. It doesn't necessarily mean that the whole jurisdiction is stable, but you at least want to know what you're getting into from a permit timeline or what have you at a project or asset level. But totally, I think for us, it's really wanting to back a strong team or a strong horse, right? If you're not that control partner and you want to take a relatively minority position in the thing, then you need a good team. I think personally, I believe in it. I think a lot of people would agree, but a great team can make a lot out of a mediocre asset or a very marginal asset to your point. But a bad team can destroy a world-class asset. So what does that mean?
Right.
Well, you can go into everything from a very, first principles technical sort of foundation of at your due diligence process. But if it's not the right team, then you need to have the pockets and the capability to switch out the team to bring in the right team that can move that asset along, or otherwise you're just going to be spinning wheels. So, I think from my perspective, if you're putting in smaller check sizes to take smaller positions in a company, you'd rather back a good team and let them figure it out. So it's really, mining it's high risk, but it is doable. You can make money in this industry. But the team, it's all about the people, I think. There's a lot of smart, passionate folks in this industry. Some of them need some guidance on the commercial front. They're passionate about the rocks and that's great. And you need that. You can always enhance that team with the right sort of commercial folks that can pound the pavement, and get the story out there. So, anyway, a bit off topic from true diversification standpoint, but I think it's just trying to figure out, what attributes you want to pick out when you're making that investment decision.
I would just pound the table on that point. I mean, it sounds very cliche, okay, we're betting the jockey and not the horse, but there are a lot of very smart, geologically minded investors who I think overlook this point. They get enamored with a certain project or a new discovery, and they're willing to tolerate not necessarily a crooked team, but even a mediocre team. I mean, we've got thousands of choices of where we can invest our money. Why not focus on the very best people? And it's not just the people that have been previously successful. You got to check that box, but also are they focused on something that they've been previously successful in? Maybe they've sold a gold project in Nevada. If they're going to focus on, round 2 in Nevada, that makes a lot of sense. If they're going to look for copper in Zambia, maybe that's a little bit less interesting. You got to look at how many other commitments the management team has. You like the CEO, he's well incentivized, but is he chairman of the board on 4 other companies and CEO of a private vehicle in addition to the company you're investing in, or is he all in on the specific venture that you're looking at? Did the management obtain their shares through cheap options, or did they put their hard-earned money directly into the company and fund it as any other investor did? So it's more nuanced than who. It's how they've gotten involved, how involved they are, how spread out they are between other opportunities. Like all those little qualitative details, I think, make all the difference.
Yep. A lot of scrutiny needed in that respect. Due diligence. Excellent. Very good. Does anyone have any questions for our panel? No? Well, look, I think we'll leave it there. And let's have a round of applause as well. Thanks.